We've all seen it. A high-powered surgeon or a corporate lawyer earning $500,000 a year, yet they're quietly drowning in debt. Meanwhile, a secretary who never made more than $40,000 a year retires with a multi-million-dollar portfolio. It feels like a glitch in the system, but raw intelligence doesn't actually protect you from financial ruin. In many cases, being smart makes it worse. High intelligence allows you to build elaborate, sophisticated justifications for emotional biases, helping you feel perfectly rational while you make choices that are objectively self-destructive. We lose money because we treat finance as a series of math problems to be solved, ignoring the fact that our bank accounts are often at the mercy of our biology. Most of us are losing because we are walking into two specific traps. We try to force the messiness of life into a rigid spreadsheet, or we trade our future security for the immediate validation of our peers. Building wealth requires you to stop looking for a more advanced formula and start examining the psychological friction that dictates how you actually spend and save. The first trap is what we can call the math game. We build these perfectly optimized, mathematically correct financial plans, but spreadsheets don't experience a middle-of-the-night panic during a recession. A plan that is purely rational on paper often shatters the moment a human being has to live through the stress of it. To survive, you have to reframe how you see market crashes. They aren't a fine or a punishment for a mistake. Volatility is simply a fee. It is the required price of admission for the long-term returns the market provides. Look at a company like Netflix. Investors who bought in during the early 2000s and held on have seen life-changing wealth. This chart shows its 35,000% return from 2002 to 2018. But look underneath. Netflix spent 94% of that run below previous highs. Those deep valleys are the emotional fee to get that return. You endured years of doubt and the feeling of losing everything. This is why a reasonable plan, one that allows for some inefficiency but keeps you from panicking, will always build more wealth than a rational plan that breaks during the first sign of human trouble. The second trap is the status game. This is the drive to buy luxury items under the misguided belief that expensive objects generate respect and admiration from the people around us. But there is a massive gap between what you see and what onlookers feel. It's called the man in the car paradox. When you see a Ferrari on the street, you don't think about the driver's success. You imagine yourself behind the wheel. The driver is invisible. The onlookers are only admiring their own desires. We judge wealth by what we can see: the cars, the houses, the watches. But true wealth is actually what you don't see. It is the assets that haven't been spent yet. It is the optionality of unspent money. When money becomes a status tool, you lose the ability to identify the concept of enough. Sam Bankman-Fried was worth over $20 billion by age 29, yet he risked everything and lost it all, chasing endless expansion and social validation. The alternative is to use money for a margin of safety. You save not to buy a specific object, but to build a buffer between your ego and your income. This diagram shows the goal. As your income rises over time, you must force your lifestyle and your ego to stay flat. That expanding gap in the middle is your margin of safety. It is the breathing room that allows you to survive the unexpected. True wealth is silent. It requires prioritizing long-term peace of mind over the short-term dopamine hit of social praise. If money isn't for buying status or satisfying a spreadsheet, what is its actual purpose? The only game worth winning is the one that buys you control over your daily schedule. The highest dividend money pays is the ability to wake up and do exactly what you want for as long as you want. But you lose that control the moment you start copying the strategies of people playing a different game. This chaotic floor is filled with day traders whose goals and timelines have nothing to do with yours. If you are a long-term investor, following the moves of a short-term trader is a recipe for disaster. You don't need their speed. You need the power of compounding. Warren Buffett's success is the result of simple, relentless endurance. He didn't find a magic formula for high-risk returns. He simply stayed in the market longer than almost anyone else in history. This growth curve tells the real story. Buffett is worth over $160 billion, but the vast majority of that, over $156 billion, was generated after his 65th birthday. Compounding only works if you stay in the game long enough for the math to get aggressive.
Ultimate financial success isn't about brilliance or beating the market. It is about defining your own standard of enough and using your money to buy back the most valuable asset in the universe,